Okay, thanks everyone for joining today. It is Thursday, 27th of November, and we are today talking about the November budget and what it means for doctors working in private practice. So, if you've not been to these webinars before, we've been doing them now for about 18 months. I think this is number 18 that we've done in our series, but they're designed to help you through the essential steps regarding sort of planning, launching, growing, and scaling your private practice. So we help you avoid the kind of common pitfalls and mistakes. We help you save time and money during that process, and we help you launch quicker so you can start to see those patients and see those revenues coming in. These are just some of the topics that we've covered. So everything from kind of CQC registration through to tax and finance. Obviously, today is more a finance related one. We've got branding and marketing. Last month was all about AI and how that was transforming the medical PA role within private practice. So recordings of these webinars are all available upon request. So please do get in touch with the team and we will send those to you. Those of you that aren't familiar with Designated, we are a full service consultancy for private healthcare clinics and practitioners. We cover everything that you need to help you sort of launch, grow, and succeed in private practice. The plan really is for you to focus on what you do best, which is treating the patients and delivering the best outcomes, and for us to look after things in the back office that perhaps you don't want to be spending time on, such as finance or medical PAs or technology or operations, those things that sort of take time out of your working week. Today, really pleased to be joined by Vicky, our CFO, who you'll have seen previously this year. She's done a couple of webinars for us previously around the start and end of the tax year, beginning of this year, and also Jake from Clearwater Wealth Management. So Jake will introduce himself in just a second. You'll be familiar with my dulcet tones. I've been hosting these now for quite some time and do quite a few webinars with webinar. I'm the CMO, Chief Marketing Officer at Designated, but I spent the last 6-7 years helping doctors set up their private practices. So that's us. Today, we're talking all about Rachel Reeves's budget yesterday, which obviously was headline news for various reasons, but it's all about how the budget can really, what it means for you. So it's understanding, firstly, some of those kind of, hygiene factors relating to kind of key tax deadlines and updates that Vicky's going to cover. We'll look at yesterday's budget and what it means for you as a private medical professional in the UK, some of those kind of key points that are most relevant for you. Jake is going to talk a little bit more about kind of investment strategies and investment planning. And we're here for a kind of Q&A at the end. So should you have any questions, obviously do let us know and use the chat function. So at this stage, I am going to hand over to Vicky and let her talk you through the accountancy side of things and some of the things that you need to know as a doctor working in private practice.
Thanks, Simon. So I thought we would start off with probably a tax that everybody knows, income tax. Looking at different types of tax in the UK, some of them, we also think of company tax, personal tax, income tax, corporation tax, but there are a lot of other taxes. So start with the income tax, basic at 20%, higher, and then additional rate at 45%. National insurance, though a lot of people don't realise, it really is a standard tax. It's obviously a tax that comes with your payroll, but also if you're self-employed. Pension tax, the fun that you will never stop paying. Capital gains tax, so whether you're selling property, shares, there is always a part to pay for HMRC. Dividend tax, so investments in limited companies or your own limited company when you're extracting information. Dividend tax will become important as we talk later because it's one of the changes that's come up in the latest budget. VAT, understand that a lot of medical services are exempt, but some of them are illegal, and some other areas are now working their way sometimes into the scheme. So it's something to always be aware of. Corporation tax, I mentioned originally, for a limited company, 9 months after the year end. And the one that everybody enjoys the most, the self-assessment tax return, 31st of January submission. But as from next year, new Making Tax Digital rules will be 4 times a year. So I will touch on that as we move on. So key deadlines, I'm sure that everyone is aware and has them all in their diary ready to go, but 5th of April, the last day of the current tax year, 6th of April, the new tax year, 31st of July on account payments, and the last day for benefit in kind. So if you've got any cars or anything or private health insurance, the P11D needs to be issued. And 31st January is the self-assessment deadline date, but it's also payment on account number 1 date as well. So one thing before we delve into the budget is the looking at the difference between people who are employed and people that are limited companies and take dividends, and the way that we need to make sure that we can understand the differences between the two. So with dividend tax, you have to be required, you have to be registered as self-employed. So if you're a director of a limited company, automatically you should then go and register because you are self-employed under the director scheme. Dividend tax is exempt from national insurance. And it can only be taken if profits allow. There's been a lot of stories in the media and social media at the moment where people are looking at extracting maximum dividends but completely ignoring the benefit or the deficit on the corporation tax. So there is no benefit to taking a dividend. The corporation tax, if you haven't taken it as a salary, can be higher. But the rates currently are 8.75, 33.75 and 39.35. But that is going up in April 2026 as of yesterday's announcement. You can add family members, meaning that they can be a shareholder within the company. That could be a wife, a partner, a child, if the age limit is allowed, and they can then take dividends from that company. Payroll tax, a PAYE scheme must be set up. So that's registering with Companies House and HMRC that you are a limited company that is employing, X amount of people. It attracts national insurance. It can be taken no matter what. So you can physically make a loss in a limited company if you've taken a director salary. That's not, illegal. All salaries that are put through on payroll are fully tax deductible, so they come off the bottom line, and the rates sit at 20, 40 and 45. And again, you can add on any member of the family or anyone that is working for you into this, but they will obviously be taking those rates as well. So, on to yesterday's budget. After a lot of speculation, I think it was probably the most unknown budget in all the years that I've been working in this profession, apart from obviously the leak that came out very early, which they're still obviously looking into. Chancellor's announced further 26 billion in tax increases. The most high profile topic was changes to salary sacrifice, but I also believe the dividend rate as well. If you look at the numbers, they're saying the largest revenue generator is planned to freeze income 28 to 2029, which comes in line with the new votings, but it's expected to raise 8 billion. It's a lot of money, and I think it's a budget that came from no speculation, but has obviously real implications in the next year. So the key takeaways, thought I'd try and keep them nice and clear, but the ones that really are relevant to you guys in the medical profession. Income tax and national insurance thresholds, they are remaining to be frozen. On the outset, people think, oh, that's a really good thing. Income tax is not going up. Well, it is in a way. This is it's effectively increasing taxation on earnings. Dividend tax rate. I honestly believe this is one of the biggest issues with yesterday that is only really coming to light now. It wasn't in the main headline, but it's going to increase by 2% from April 2026. So, the structure of a limited company, people going in, taking a minimum salary and then taking dividends on top of that, really there's going to be some work to do to see whether this is financially viable. And then tighter taxations on saving, interest and property income. In 2027, this is really going to hit people who have got investment portfolios. There's obviously new rates. So if you're not a limited company and you have property and you're self-employed, the rates that you're going to be paying taxation are going up as well. So cash ISA allowance for under 65 has been reduced down to 12,000. So again, I know a lot of doctors who will extract that money, put it into ISAs. That's not, the volume that, you're going to be able to do is not there. State pension is rising by 4.8 in April, but they have said that they will continue to tax the retired people. So, they're giving with one hand and taking away with the other. High value property surcharge. This is going to be like, on properties over 2 million, there is a minimum of 2,500 additional tax that's going to be, put onto these. And one point that I wanted to put through, which again, I didn't see massively speculated at before, but it's electric vehicles. So the move from the mileage-based road tax scheme, basically the full benefit in kind been zero or very, very low. That is now going to go up, meaning that electric vehicles may be good for a limited company deduction, but actually on the person, if they're in the higher rate of tax, that's actually going to increase the taxation that they're going to be paying on the self-assessment or through their P11D. So it's really not a good thing when it's been something that has really been championed in the last few years to go ahead in your company, buy yourself an electric vehicle. So it is 2028 and there is still time. So there are some benefits around it I'll talk about. But we need to be aware that those changes are coming and how we prepare. So the specific implications, higher effective personal and corporation tax burdens will be there for the medical industry, unfortunately, for those trading through limited companies. There is no way around it. As I mentioned before, making tax digital, can't speak, is coming in on the 1st of April next year. And when it comes in, everybody of a turnover that's self-employed of £50,000 will be having to report their taxes once a quarter and pay their tax that they're owed and then a payment on account. So people who are self-employed and limited are both going to feel this. Dividend extraction strategies really need to be reviewed. I think it's the key takeaway that 2% could be the difference between the bandings of how you do things. Do you then put different people in as shareholders onto your company? Do you actually look at putting yourself, if you're working full-time in your practice, do you look to put yourself fully on a payroll? And does that then take down your corporation tax, which will marginally reduce your overall tax burden? The pressure on net personal income for high earning consultants, the tax bands are not moving. There's no allowance for anybody. It's only going to be bad news, unfortunately, in that one. But again, it's something with the right advice, you can try and negate how your income is classified. Greater importance on structured pension contributions, and this is something that Jake is the master of advising on. But in terms of the efficiency in terms of paying into investments and pension pots is wilder than ever now. The opportunity to be able to save tax and to be able to ensure that your income stream isn't affected is really, the time is now. Medical professionals with property investments face higher medium-term tax exposure, but again, we have some time to look at that. It could be a case of, have you got a portfolio? Could you limit that company? Again, there's different things that we can look at. And consultants using electric vehicles for private or company use will find higher costs going forward. So this may be looking at the lease finishing in early 2028. That could be, a great way to still get the allowances between 2025 and, then. Or actually looking at, is it better to do things in a different way, that you can start looking now. So again, some real research to be done in the area. So I think that reviewing, as I said, the salary dividend extraction is pivotal for anybody that is working in private practice and has the ability to do so. Checking that your maximisation of your pension contributions, is there ways that you can extract more data from your limited company? Do you have more funds out of your self-employed income that you can put in? Looking and speaking to an IFA to see what else is there. If ISAs are no longer, if we can put 12,000 into this, but what can we do elsewhere? How else can we do this? This can help to unburden the ISA allowance issue. Evaluating the property portfolio and looking at, again, how do we structure that? Vehicles, as I said, looking at plans, not just for when this comes in 2028, but how can we maximise our tax efficiency between now and then? And I always say, I'm taking a full efficiency review of both your personal and company structures, going through, as always, my top tip, going through your bank statements in your limited company and your personal company. Are you claiming everything that you should? Is there anything that you can change? Are you now working at a different rate? Whereas when you first came into the industry, you were working 1 day a week, you're now working 3. Is your company structure correct? Self-employment still the right thing for you, or is a limited company a better way? Or other way around, I've got a limited company, but actually I'm only doing X. Okay, what's the benefits for being self-employed? These things, although they can be probably boring for some people, if you take an hour or so to speak to a financial professional, they can then review all of this information for you and come up with the right structure so that you have time now with, end of November. None of this stuff is coming in until April. You have a nice time to still make changes for your tax. Obviously, you're still, the tax year runs till the end of March, give or take. There's still at least 3 months of the new year and 1 month left of this year that we can make changes with.
Perfect. Thank you, Vicky. So yeah, I'm here to kind of talk about investing. And thanks for the intro at the start, Simon. But essentially, I work with doctors who have private practices alongside NHS work or just their private practice, and I help them manage their finances personally and within the business, similar to Designated. A big part of what we do is help our clients invest their money. And I think the quote on screen kind of summarizes investments and kind of the fear around that and kind of puts some people off. The quote says, "Fear and euphoria are dominant forces that drive the financial markets. Learning how to manage them is key to successful investing." So if we just go to the next slide, Simon. So this is really interesting slides. So this essentially shows us why we need to invest and why individuals need to invest their money to make money so they have, a successful financial future. On screen, what you can see is 20-year performance of 3 different asset classes, as well as inflation. And what it shows, if you had invested £100,000 20 years ago, what the value of that £100,000 would be today. So the green line on screen is cash. So if you kept your money in cash, you wouldn't have made any money. And what you actually notice is that the yellow line, which is inflation, is higher than the green line. What that essentially means is that the value of your money or the cash has gone down over time. So you've got less purchasing power. The other 2 colors on there are equities and bonds. So equities are shares in a company. So if you think of a Microsoft, an Amazon, a big company like that. Bonds are more of an IOU. So in the UK, the government issues something called gilts. So you lend the government money, they give you a coupon rate or an interest rate over a number of years, and then they give you your money back at the end of that period. You'll see that bonds just outpace inflation, but you'll also see that equities significantly beat inflation over time. However, when you take a step back and you look at those lines, you can see that the blue line, you go on quite a journey. So it's quite volatile in terms of going up and down over time. If you compare that to the green line, which is cash, cash obviously doesn't go up and down in your bank account unless you're spending more money or earning more money. So, we would say there's no kind of market risk with cash, but there's inflation risk with cash. The difficulty is when you're investing is then kind of understanding what mix of bonds and what mix of equities do you have, and then also what types of equities and what types of bonds you invest into. So, and just to kind of show you that, this slide shows you the best performing asset class since 2004 to 2024, so the same 20-year periods. And what you'll notice is that different asset classes and different regions. So for example, if we go to 23, 24, you'll see that US equities was the best performing region. What you actually see as well in 21, 22, that cash was the best asset class in that year. So it's incredibly important when you're investing is that you think about diversification. And that's something that we help clients with, because everyone would have heard the analogy that you don't want to put all your eggs in one basket. Because if you put all your eggs in one basket, you'll run into difficulties in the future. Something else that we often speak about in our industry when we're working with clients is almost this behavioral coaching side of financial advice. When you invest, and we saw on that first line, particularly with equities, there's going to be volatile periods and periods where it feels quite uneasy. We're here to help and guide our clients around that. Particularly, what this is showing is that actually sometimes the best thing to do is not react or not panic and not do anything. So the chart on screen, just to kind of explain it, shows had you invested £100,000 20 years ago, if you stayed invested, and this is looking at equities, the value of that £100,000 today would be 710,000. So over 20 years, you've 7 times your money, essentially. However, if you had missed the 10 best days, so 10 best days of investment performance in a single day, you would only have 404,000. And the more best days that you miss, that number gets smaller and smaller. And 40 days out of the 20-year period, you'd have a fraction of what you'd had you stayed invested. So a big part of what we do is obviously investments, as I've covered there, but we also help clients understand, where they're on track to get to the future in the future. Everyone wants to retire, or most people want to retire at some point in time. My job as a financial advisor is to help you understand whether you're on track to retire when you want to retire, and if not, what strategy do we need to implement to ensure that you can retire. So this is a tool that we use with all of our clients. It's a cash flow modeling tool. So we plug all your financial data into that, and that will essentially give us a projection to the future. And what you'll see in this scenario is the red is showing that this particular client is running out of money at 80. And what the tool does is it gives us an understanding of what they might need to do to eliminate that red so the plan is successful. So you can see additional savings needs. So they need to save an extra £20,000 a year, or if they can't afford to save any more money, they can rely on investment returns. They need to get 7.52%. Or if they couldn't do anything, the plan is currently saying that they can afford to spend £28,965 a year in retirement.
Back to you, Vicky, if that's okay, just to finish.
Yeah. Sorry, I was engrossed. That number, 100K over all those years. My goodness, God, just got to have that money first of all, haven't you? So the key takeaways, I think, from yesterday's budget are tax planning. Know your dates. What do you owe? Is there any way to make a change? You've now got till the end of the tax year to make the changes. Yesterday's budget. I think going through this again and understanding, does this affect me? Am I a limited company? Right, okay. What's the implications for me? Do I have an electric car? What's the implications for me? And stay in control. Decide what you want to pay, when you want to pay it, but you can't evade what they tell you, but you can work with your accountant or with your IFA in terms of your accounting needs and your investment needs. You're the boss. Take responsibility for your own finances, because no one else will do that. Accountants can help you and guide you, but ultimately your business is your own. And if you have the right resources around you, you can make the best decisions. It's like everything with life. Knowledge is power, isn't it? So my last part is get specialist advice. Are your accounts healthy? Is there anything that you can do better before the end of the tax year, or by 2027, 2028, have these goals in mind? What funds are available? How can you invest these? even a small amount, as we've just seen on there, can make a massive difference. And starting now in terms of planning, over the years of what you can invest can be a really good thing. I think it was said one day, when's the best time to invest? Today. So that's really something to take away. I think making sure your accounts are fit, financially fit, and the availability of the money is there, and then use those to invest in the best possible way, that whether that be stocks, shares, bonds, investments, or pensions. So I think there's a lot to do, really. Obviously, at Designated, we full service provider, as Simon said. We run a full accountancy division that can help with any of these. If you've got any questions or anything that you have listened to this and then thought, how does this affect me? Then, more than welcome to send those in, and we can book some time to do a bit of a check on your accounts.
Thank you, Vicky. Jake, brilliant. Thanks very much. We're a bit short of time today, so we'll probably skip the questions unless anybody does have anything they want to ask. Do use the chat function, but obviously you can contact us at any time, info@designatedmedical.com, and ask us a question. But do pop something in the chat if you do want to ask a question. What happens next? Well, as Vicky just said, we're here to support you. So, we cover a whole host of different topics each and every month. Today it was all about the budget and the financial implications of that for doctors. But if there's anything you want to talk about, whether it's CQC registration, marketing your practice, that you want to drive more patients, whether it's relating to medical PA and practice management, do get in touch. We do have a private practice WhatsApp group, which is fairly active, and we post the webinar recordings on there, and we encourage our community of practitioners to engage and share ideas and knowledge, which is great. So do join that, and don't forget our webinars will continue into next year. So we've got one more coming up in December, which is all about the benefits of online and upfront payments. So historically, private practice, you would see the patient and then send them an invoice afterwards, and then have to collect that money from them. So what we're seeing is a trend towards online payments as websites become more prominent, where you can take the money up front before the consultation. There are cancellation periods, but there are huge benefits in order to do this, and also the patient experience too. So we'll be covering that in a bit more detail. Hopefully we'll have a couple of guest speakers as well that will come and join us. And then we're going to come back in the new year with a host of new webinars that we'll be announcing next month. It's been a busy year, so we haven't quite got round to what the program is. But if you do have ideas and suggestions for those, then do let us know. Do drop us a note, WhatsApp or an email, and we'll incorporate those. So that is all for today. Thank you very much. Big thank you to Jake and Vicky for taking their time out of their lunch hours to tell us all about yesterday's budget and what it means for you. And we'll see you next month. Thanks very much.
Thanks, Simon. Thank you, Jake.
Cheers.